Hey guys, how's it going? Welcome back. This is the fifth video in a series of 10 designed to look at each unit of the Diploma in Financial Studies. Topic 5 looks at whether debt is good or bad. As part of the Topic 5 video, we'll be seeking to look at benefits and costs of borrowing, different interest rates on different borrowing products, attitudes to borrowing and debt, financial footprints, different solutions to individuals in unmanageable debt, and different cultural perceptions of financial products. So let's first look at some of the benefits of borrowing then. So it enables individuals to make purchases that they would otherwise not be able to afford. These are things like a car potentially, or even a house. It might also take too long to save up to buy these items outright, which means that borrowing is needed, for example, to put a roof over one's head with a house. Alternatively, some people might choose to rent, of course. But with a car, you might require the use of a car to get to work, for example, and therefore saving up to buy the item might not be suitable in that scenario. Inflation could also make the item more expensive by the time the amount has actually been saved. This means that actually borrowing money now to buy an item might be cheaper in the long run compared to saving up for that item when inflation will make the price more expensive by the time you come to buy it. However, that said, the costs of borrowing. When individuals borrow money, they have to pay it back along with interest. Interest on certain types of debts, things like payday loans, can be extremely high. The repayments also need to be factored into future cash flow forecasts when you borrow. And repayments also present an opportunity cost. Essentially, the fact is they need to be factored into future cash flow forecasts, which means that the borrowing interest you have to pay presents an opportunity cost because that money could have been spent elsewhere. And defaulting on a loan, if you choose to borrow, is a serious matter. This can have lasting impacts. Now, there's two types of borrowing, both secured and unsecured. Secured means essentially you're putting up some collateral, some security against that borrowing. So if you are unable to pay back a mortgage, for example, the lender may be able to repossess your house. Unsecured borrowing, on the flip side, means that you are not putting up collateral. So let's look at some of the different interest rates of different borrowing products. Now, this source is the provider's websites in 2021. The first different borrowing product we're going to look at is payday loans, and some popular payday loan organisations include Lending Stream and Moneyboat. You can see here the representative APR, or annual percentage rate, is extremely high. Lending Stream at 1,333%, whereas Moneyboat only a touch below 1,000%. So extremely high APRs over the year. Of course, the idea with payday loans, of course, is that they're only loaning you that amount for a certain or short period of time. Store cards are another opportunity to borrow, and here's two examples from Argos and New Look. The Argos card has a 34.9% APR, whereas the New Look has a 28.9%. These are both significantly lower than the payday loan rates, as you can see. The thing with store cards is that you might actually get benefits from that particular store. By spending at that particular store, for example, you might get money off, discounts, or other incentives. Credit cards are another option. With the Sainsbury's Nectar credit card, for example, you accrue Nectar points, and Nectar points can then be spent on different items within Sainsbury's or at other stores. Tesco Bank and Royal Bank of Scotland credit cards are other options. You can see here that the APRs are actually slightly less than the store cards, 20.9, 9.9 and 12.9. But these do require a good credit rating in order to get the card. We'll have a look at credit ratings later on. Other credit cards which do not require a good credit rating, Metro Bank, Capital One and Vanke's Visa, You can see here that APRs are significantly higher than the good credit rating credit cards. For example, the Capital One has a 34.9%, whereas the Tesco Bank low APR card just 9.9%. So if you do have a good credit rating, it might be worth looking at those three cards. Personal loans, £7,500 unsecured, repaid over 36 to 60 months, so that's 3 years to 5 years, include the Barclays Bank personal loan nationwide and the M&S Bank cardholder loan. You can see here significantly lower APRs than the credit cards, the store cards, and in particular the payday loan options. And coming down to the bottom, mortgages. These are generally the lowest interest rate. However, as you can see, personal loans with Nationwide and M&S Bank are actually lower back in 2021. Mortgages in 2021, Coventry Building Society at 4.64 and HSBC and First Direct in the 3% range. That said, this was taken from 2021, and the Bank of England's Monetary Policy Committee has set their interest rates significantly higher this year, and therefore these typical interest rate examples are to be taken with a pinch of salt, because the majority of them are likely to be higher in 2023. So what are some of the attitudes to borrowing and debt then? Well, debt is commonplace in most modern Western societies for both businesses and for individuals. Reasonable levels of personal debt are actually accepted as the norm now, whereas many years ago people might have shied away from taking too much personal debt. It has become normal to have a certain level of personal debt. Younger people are more likely to have to borrow when starting out in adult life. Because interest rates are significantly higher, inflation is higher, the average price of a house compared to yearly salary is significantly higher, younger people are more likely to have to borrow. However, that said, many people may find themselves over-borrowing, and they may find themselves getting into financial difficulty. This, along with irresponsible lending by providers, was one of the major factors that led to the 2007-2008 financial crisis. So how can we balance the benefits of borrowing against the cost of borrowing? Well, when looking to borrow, individuals should 1. Consider their current debt situation and assess whether it would be a good idea to borrow more. They should compare different products to find the best deal, but don't apply for lots of different products at one time, as this could have a negative effect on the individual's credit rating. When looking to borrow, they should ensure the interest rate they pay is reasonable when considered against the purpose of the loan. They should also consider the appropriate length of time a loan should be for, i.e. a 25-year mortgage would be appropriate for a house purchase, but may not be appropriate for smaller purchases. So when we're talking about financial footprints, what do we actually mean? Well, lenders will use credit reference agencies to consider the credit history of potential borrowers, i.e. before they give out loans, mortgages, or other lending, they will consider an individual's history of borrowing, i.e. have they borrowed large amounts in the past, and more importantly, have they been able to pay that back on time and in full. The three major credit reference agencies we need to be aware of are Experian, Equifax, and Call Credit, otherwise known as TransUnion. The details of every loan, credit card, or other credit agreement that an individual has or has had are recorded in by the credit reference agency. By doing this, the credit reference agency builds up a picture of how much the individual has borrowed and how good they are at making the required monthly payments. That said, credit reference agencies only keep information from the last 6 years of an individual's borrowing history. Whenever a person applies for credit and the lender searches their credit file, this will leave a financial footprint, essentially a record of when a person has applied for credit and the lender whom with they applied. Things that leave a negative footprint, i.e. a negative trace, will include things like applying for many loans in a short space of time. To the credit reference agency, this shows that potentially a person may be somewhat desperate to get extra money and may not be in control of their own financial dealings. Defaulting on a repayment will also leave a negative footprint. For example, not paying a loan when it is required, not paying a credit card off when your payment is required, and of course not paying a payday loan off when that payment is required. These are all examples of defaulting on a repayment. A third thing which might leave a negative footprint is when you build up payment arrears. This is when you fall behind on payment, and arrears are those missed payments, essentially building up for future repayment. Of course, if you do get into a situation whereby you owe arrears, then the interest on those arrears will be added to the current interest on your loan, which means that essentially you'll be paying more interest off overall over the course of your loan period. Individuals can improve their credit rating, however. So how can they actually do this? Well, a couple of different ways. Firstly, paying off debts on time. When the debt becomes due for paying it off on time will improve your credit rating. Paying off debts in full will also improve your credit rating. For example, if you have a credit card, paying off more than the minimum payment, i.e. paying it off in full each month, will improve your credit rating. So when we're looking at different borrowing methods, if we get into unmanageable debt, what solutions are there for individuals? Well, the first thing I would recommend is seeking advice. There are a number of different organisations out there which provide advice. The first one, which is free and funded directly by the government, is Citizens Advice. Citizens Advice, of course, used to be called the Citizens Advice Bureau, but now it's just known as Citizens Advice. This can be accessed online or in branches up and down the country. They might advise you to go down one of 5 different pathways: informal payment plan, debt management plans, debt relief orders, individual voluntary arrangements, or bankruptcy. Let's compare those 5 different solutions now. So, will the debts be frozen? Will there be no more interest or other charges on the debt? Well, with an informal payment plan, of course, you can see that only if the creditor agrees, and that's the same for debt management plans. With the other 3 solutions, debts will be frozen, which means essentially that there won't be any more interest or other charges, and the individual lender cannot come and seek further repayments at that time. As I just said, you are protected from action to recover the debts by the lender with debt relief orders, IVAs and bankruptcies. So the lender cannot come after you. So that will provide some protection to the individual. The amount of the outstanding debt which is repaid is 100% with informal payment plans and debt management plans. With debt relief orders, none of the outstanding debt will be repaid, and with IVAs and bankruptcy, it can be slightly more, between 30 and 50% with IVAs, and whatever can be raised by selling debtors' assets with a bankruptcy. So what is the actual cost of these 5 options? Well, with an informal payment plan and debt management plan, there is no cost. Debt management plan, if you're using a free online debt advisor, that is. Debt relief orders cost £90, whereas IVAs cost around £7,500. Bankruptcy will cost you around £700 court fee, plus any solicitor fees. So what is the minimum and maximum total debt which you can have in order to apply for one of these 5 different solutions? This is going to be a major impact on whether one can apply for any of these 5. And if you should get a case study within the exam which might have a specific amount of borrowing, then that will determine whether each of these are suitable. So with an informal payment plan, there is no minimum amount of borrowing. That said, the maximum is limited to an amount that can be paid back over a reasonable amount of time, so somewhat subjective. The minimum is usually £5,000 with a debt management plan. Once again, the maximum is limited to the amount that can be paid back within a reasonable time. Debt relief orders, the maximum is £30,000. IVAs, the minimum is £10,000 but has no maximum. And with bankruptcy, there is no minimum or maximum amount of total debt. Do the debts get discharged? Essentially, do the debts get taken away? Well, with an informal payment plan, only after full repayment, and that's the same with a debt management plan. But with a debt relief order, your debts are discharged in full after 12 months. IVAs after 5 years, and once again bankruptcies after 12 months. Are your assets affected? Essentially, is your car, your house, or other items of value affected? Well, with an informal payment plan, debt management plan, and debt relief order, no, your assets are not affected. With an IVA, you'll have to pay any savings into the IVA at the outset, so when you apply for the IVA, and you may have to use any available equity in a property to pay debts off. With bankruptcy, often seen as the most severe of these 5, all non-essential assets will be sold to help pay off the debt. Homeowners have to sell their homes, so a very serious solution. Is there any restrictions placed on the debtor, i.e. the individual who has got into this unmanageable debt? With an informal payment plan and a debt management plan, no, there are no restrictions. But if applying for a new loan, if you have a debt relief order, the individual must tell the lender about the DRO. You are allowed to keep a bank account, but you are not allowed to have an overdraft. With an IVA, you may not be allowed to be an accountant or a solicitor, and you cannot take out any new unsecured credit. With a bankruptcy, it's similar to an IVA, but you're also only allowed a basic bank account, and you will be barred from certain professions. These include things like financial advisor, for instance. So what impact will there be on your credit history? As mentioned earlier, each solution will leave a negative financial footprint on a credit record for 6 years, as this is the amount of time that a credit reference agency holds information on individuals for. So what are the different cultural perceptions of financial products? Well, people from different backgrounds will view borrowing products and debt differently. Some people have no concern at all about getting into debt, or some may wish to avoid it at all costs. Under Islamic law, for example, Sharia prohibits the paying and receiving of interest. Someone's perception of debt can quite easily change over their lifetime as well. They might marry into a different culture, which might change the perception of debt. They might experience financial hardship, which might mean that they might manage their money in a different way within the future. They might also be affected by economic factors. The credit crunch and recent interest rate rises are both examples of this. So, now that we've looked at topic 5 of Unit 3, let's check our knowledge. But before we do so, make sure you smash that like button and hit subscribe so you're notified of any future video releases, including case study reviews and model answers. Which of the following would usually charge the lowest rate of interest? Is it a credit card, a payday loan, a personal loan, or a store card? The answer, of course, is C. A personal loan would usually charge the lowest rate of interest out of those 4 options. Which of the following is a credit reference agency? A. Experian, B. Money Dashboard, C. Step Change, or D. Zopa? The answer to question 2, of course, is A. Experian is a credit reference agency. Which of the following debt management solutions does not have legal and administrative fees? A. Bankruptcy, B. Debt relief order, C. IVAs, or D. Informal payment plans? The answer is D. An informal payment plan does not have any legal and administrative fees. Make sure you click on the link to access the next video in the series.